am Tony Wickenden, and welcome to this applied learning programme on the government support schemes that are available to you. There has been, and it won't surprise you, unprecedented and much used word, interest in these schemes. So I think it's really important that you get to grips with how these schemes work, how you can access them if it's appropriate, but more so how you can explain them to your clients. Because where you probably won't be the person who goes online and helps your client make the application, it will be important that you have the information that your clients will want, the understanding that your clients will want when they come to you, hopefully as they will, to ask you about those schemes and how they work and whether they work for them. And if so, how do they get access to the funds, the loans, the grants, the money, the deferment of tax that's available to them. I've designed this applied learning program to give you the information you need in what I believe are the most important of those government help schemes, those arrangements that are now available to the businesses that can apply for them. You need to be on top of this. I hope that this program will help you be on top of it. So here we go, enjoy.
In the 16 days from the budget on the 11th of March, we had an unprecedented number of announcements made by the government to help overcome the economic damage caused by the coronavirus. These announcements were in relation to schemes and help set up for individuals and businesses. The underlying theme for all of the measures introduced to help individuals and businesses was that the government would do whatever it takes to ensure that the economy remained in as good a shape as it possibly could to take us through to the other side of the pandemic. The announcements made can be simply categorised into these three categories: grants, loans and payment deferral, and by payment I'm referring to the payment of tax. As this slide illustrates, there were a vast number of new acronyms brought into being by the Whatever It Takes initiatives, including the JRS, the Job Retention Scheme, the SEISS, the Self-Employment Income Support Scheme. We've had self-assessment deferment, VAT deferment provisions, and the continuation of the time to pay arrangements, as well as the CBILS, the Coronavirus Business Interruption Loan Schemes, and many more. My focus and our learning objectives for this programme are these: the Job Retention Scheme, the Self-Employment Income Support Scheme, Business Grants, Coronavirus Business Interruption Loan Scheme, VAT and Self-Assessment Deferment, and the Time to Pay Arrangements. These represent the areas that I believe you will have the greatest interest in, and I hope I'm right. There are 4 periods to consider when looking at how the Job Retention Scheme works. The first is from the 1st of March to the 31st of July. Then there's the period from the 1st of August to the end of August, then the period 1st of September to the end of September, and then the period from the beginning of October until the end of October. So let's have a look at that first period, 1st of March to the 31st of July. This is how it works. Remember, it's the employer who claims the grant from HMRC, the furlough grant, and it's the employer who pays the employee. The employee does not claim directly from HMRC. So the employer needs to pay the furloughed employee at least 80% of their wage, their salary, to be able to claim the furlough grant. They can, of course, pay more than that if they want, but they can only claim up to 80% of the furloughed employer's pay, subject to a maximum of £2,500 per month. The employer can also claim the national insurance, the employer's national insurance, on the payment, the furloughed grant, an amount up to the amount of the furlough grant, the employer's national insurance on it, and can also claim an amount up to the minimum the minimum auto-enrolment contribution, and that's up to 3%. So that could actually be, they could claim back an amount up to that amount if they actually pay the auto-enrolment contribution, or up to that amount if they, as an alternative, pay an ordinary pension contribution, so up to 3%. It's important to note that a furloughed employee can carry out no work for the employer during the furloughed period. However, this is an important however, from the 1st of July, remember that's from the 1st of July, the employee can come back on a part-time basis, part of the government's plan to get the economy working again. So an employee can come back on a part-time basis. The employer must be responsible for and pay the wages for periods of work actually carried out, but can continue to claim in respect of periods of furlough where the employee isn't actually working. Now let's have a look at the period from the 1st of August until the end of August. The rules are broadly the same as they were for that period up until the end of July. The employer can continue to claim up to 80% of the furloughed employee's pay. They must pay the employee at least 80%, and the maximum remains at £2,500. Everything else is the same as that period up until the end of July. The big difference is that the employer will no longer be able to claim the employer's national insurance, that is an amount equal to the employer's national insurance, and can no longer claim the amount up to the auto-enrolment minimum contribution. Now, for the period from the 1st of September until the end of September, the maximum amount that the employer can reclaim from HMRC as a furlough grant drops to 70% of the furloughed employees' pay, and that's subject to a maximum of £2,187.50 per month. The employer can, of course, not reclaim national insurance, employer's national insurance, or an amount up to the auto-enrolment pension contribution. That was as it was for the period up to the end of August. Part-time work continues to be permitted. For the period from the 1st of October until the closure of the job retention scheme on the 31st of October, the amount that the employer can reclaim from HMRC as a furlough grant falls to 60% of the furloughed employee's pay, subject to a maximum of £1,875 per month. Let's have a look now at who can be furloughed and who can claim. First, who can be furloughed? Employees on the PAYE payroll on the 19th of March and for whom a real-time information and RTI return was made on or before the 19th of March. Those employees could be full-time, part-time, agency workers, those on 0 hours contract even. Those on sick pay can also be furloughed, but after their sickness ends, because during sickness they're not working and they'll be receiving sick pay either at the statutory level or at a higher level if the employer pays at that higher level. Also, those made redundant since the 28th of February can be furloughed, provided, of course, that they are re-employed. Who can claim? Well, employers who have created and started and ran a PAYE scheme on or before the 19th of March. The amount that's referred to in relation to determining the amount of the furloughed pay that can be reclaimed from HMRC depends on, in relation to full-time employees, whether that employee is on a fixed pay arrangement or a variable pay arrangement. By fixed pay, I mean where your salary is known and you get the same amount each month, which is going to cover most people. For those, it's the actual salary they received on the 19th of March. For full-time employees on variable pay, then it's the higher of the amount received in the same month last year, or the average monthly amount received over the last 12 months. It's quite important to note that discretionary bonus and commission payments are not taken into account. But if there is an amount that's owed in relation to a past earned commission or bonus payment that you are now contractually entitled to, then this can be taken into account. So let's have a look at the how and when and some other stuff. Well, a claim for a furlough payment is made through a portal. It seems to be working quite well. Payments are made relatively quickly after a successful claim is made. The minimum period of furlough is 3 weeks. In and out is possible, therefore. So if you had, say, 20 staff and you didn't need them all, you could put 10 on furlough and let the other 10 work for a minimum period of 3 weeks, then reverse it so that the first group comes back to work from being on furlough and the second group goes on to furlough. Not all staff have to be furloughed. You'll definitely need to do all the necessary legal things. Make sure that there is written confirmation of furlough and it's aligned with the contract of employment. And there are multiple caps. Those caps apply for multiple employments. with different employers. So let's have a look now at owner-managers, shareholding directors. There's been a lot written about this category. Category of an individual who may draw money from their business by salary or dividends. Maybe all dividends, maybe all salary. But there are two ways in which these people can withdraw money from their business. Although there's been a lot in the press around this subject, it's very clear at the moment anyway that only salary is covered by the furloughing arrangement. It is not possible to refer to dividends. Directors can carry out statutory duties. You'll recall that to be qualified as a furloughed employee, you must do no productive work for the employer. In fact, generally no work for the employer. Directors can, however, it seems, carry out statutory duties, and one of those 7 statutory duties that are in the Companies Act is to promote the success of the company. So what does that mean? Well, the Revenue HMRC have given some guidance, and they state that there should be no work of a kind that the director would normally do to generate commercial revenue or provide services to or on behalf of the company, which would seem to rule out any kind of productive work being carried out by the director if they want to furlough. Some questions have been asked as to whether they can continue to do some of that productive work in their capacity as a shareholder. And they clearly cannot be furloughed as a shareholder because they are not employees as a shareholder. When they act as a shareholder, they're someone who has provided money for the company, is an investor in the company, who owns shares in the company. So what work could they do, given that they can't receive employment income in relation to their activity as a shareholder? Could they do other productive work? It seems from the guidance that the likely answer to that is no, but at the time of recording we don't have that answer. Let's turn now to the Self-Employment Income Support Scheme, and we're going to look at this by asking the questions: who can qualify for the SEISS, how much can they get, and how do they make the claim? Who can qualify? Well, anybody who's self-employed or a member of a partnership, including an LLP. That person must also have submitted an income tax self-assessment return for 2018-19 tax year. They must be trading on application, or would be but for COVID-19. And here's an intention test. They must intend to trade in tax years 2020-21. The government want to support viable businesses. There's also a condition they should have lost trading profits due to COVID-19, although at the point of recording it's not clear as to how that loss would be measured and when it would be measured. There are some other important conditions too. The person claiming must have had self-employed trading profit of less than 50,000, and that trading profit, that self-employment income, must represent more than 50% of their total income. But for what years? Well, for one of these two periods, they can satisfy that less than 50,000 trading profit and more than 50% of total income in relation to self-employment income for either of these two periods. The first, 2018-19, the 2018-19 tax year. And the second, the average self-employment income was less than 50,000 for the periods 2016-17, 2017-18, 2018-19. So add all of the trading profit for those periods together, divide by 3 and see if it comes to less than 50,000. That would also allow you to tick the box of your profits being less than 50,000. So you've got two opportunities: your profit less than 50,000 in the 2018-19 year, or that average profit for those periods being less than 50,000. By the way, if you've only traded for two of those years, say 2017-18, 2018-19, it's the average of trading profits for those years that's taken into account. Of course, for whichever year you select as the one you're going to go with, you also in that year need to be able to prove that your self-employment income represents more than 50% of your total income. So how much can be claimed? Well, this is a little simpler. 80% of average profits from the tax years 2016-17, 2017-18, 2018-19, or two of those years if you've only been trading 2 years, or just 1 year, 2018-19, if you've only been trading for that year, subject to a maximum of 2,500 per month. And it's also really important to note then, though, so that if you don't have a self-assessment return and you weren't trading in any of those years, then you just can't claim under this scheme. So when can you get your money under the Self-Employment Income Support Scheme, assuming you qualify, of course? Well, it's for the HMRC to invite you. They will be assessing their records, and then they will be inviting qualifying self-employed people to claim under the scheme. So there's nothing you need to do or can do at the moment. It's a case of don't call us, we'll call you. The call will be given to you, the invitation, late May, according to HMRC, for you to make the claim in June, and the payment will then be made as a single taxable sum. A little later than the extension of the job retention scheme, we now know that the self-employed income support scheme will also be extended effectively up until the end of October. Claims will be possible in August. That is a second claim after the first claim has been made for the first few months. The payment will be made as a single sum up to 70% of profit, not 80%, as was the case for the first claim. So 70% of profit, subject to a maximum of £6,750. So it will be paid again, like the first claim, as a single sum. All other conditions for claiming under the Self-Employed Income Support Scheme remain the same. Now, a fairly well-voiced and fairly frequently voiced criticism of the Self-Employment Income Support Scheme, the SEISS, is that it isn't available to anyone who hasn't submitted a tax return for the 2018-19 tax year. So recently self-employed people can't claim under that scheme. However, Scotland seem to have taken notice of these observations, and they've introduced the newly self-employed Hardship Fund. That's designed to help those recently self-employed who cannot qualify for the SEISS because they started self-employment too late to submit a 2018-19 tax return. To claim, you have to sign a declaration confirming that you meet all of the criteria that are stated for the newly self-employed Hardship Fund scheme. And the main one is that you became self-employed on or after the 6th of April 2019 and didn't submit a tax return, including income from self-employment, for the 2018-19 tax year, which would have enabled you to qualify under the SEISS. The other conditions are broadly similar to those that you need to claim if you had claimed under the SEISS. 50% of your individual income should come from self-employment. Your trading profits should be below 50,000 in the 2019-20 tax year, and you will need to give a self-declaration in relation to those points that you satisfy the criteria. But it's certainly helpful in Scotland that this newly self-employed Hardship Fund has been introduced. So let's have a look now at small business grants. There's a £10,000 small business grant. This is a grant, not a loan, one-off payment, non-taxable, for all businesses that qualify for small business rates relief, SBRR, on property. That is with a rateable value of £15,000 or less, or they qualify for a rural rates relief. Now, for businesses in retail, hospitality and leisure, there's a slightly different scheme. They can also claim £10,000 as a one-off non-taxable grant on property with a retail value of up to £15,000. Sorry, not a retail value, a rateable value of up to £15,000. But they could claim £25,000 as a one-off non-taxable grant if they're in retail, hospitality and or leisure sector, and the property has a rateable value between £15,001 and £50,999. So a bigger grant there, quite a significantly bigger grant. As I mentioned earlier, the grant is tax-free and it's not a loan. Now, on the face of it, those grants, well, not on the face of it, actually, those grants are not available for businesses that don't directly pay business rates or would not qualify for small business rates relief. It's administered by the local authority and funded from government. Now, as a result of some pressure put on and some pretty fair outcries of unfairness, a discretionary fund, in addition to the fund that pays small business grants, has been set up. And it's available and administered by local authorities for those who are outside of the small business grant scheme. For example, they work in shared spaces like WeWork, for example. Market traders. Now, if you're in one of those sectors that wouldn't qualify for the small business grant, and you have less than 50 employees, and you can prove there's a significant drop in your income due to COVID, and that's income, not profit, then grants from, well, pretty much zero, which isn't much of a grant, up to £25,000 are available. I stress that they are discretionary, they are subject to application and consideration by local authorities. In addition to all of this, if you are paying business rates, you can get a business rates holiday for 12 months for businesses in hospitality, leisure, retail, plus estate agents, letting agencies, and bingo halls. Clickety-click. In addition to the other UK-wide COVID help that's been introduced by the government, Scotland has also introduced a pivotal enterprise resilience fund. This is a grant that can be applied for by businesses who support, they can show that they support Scotland's productive capacity. They're of local economic importance, and it's just necessary to satisfy one of these conditions. Leverage on wider business community by demonstrating the impacts that the business has on supply chain at local, regional and national level. It could be a supplier or a potential supplier to the NHS or other COVID-19 vital services. Could be a supplier to other essential businesses, and you could demonstrate a need to rapidly scale up or diversify due to COVID-19. It's available for companies, employers with up to 249 employees that have been trading successfully, so viable businesses before COVID-19. They should have less than 50 million turnover and a balance sheet total of not more than 43 million. You can demonstrate that funding will support the business to be viable. We're not in financial difficulty before the 31st of December 2019, and that this is an important one, you are a Fair Work employer or working towards becoming a Fair Work employer, and of course that you have a business bank account. Another additional scheme introduced in Scotland is the Creative Tourism and Hospitality Enterprises Hardship Fund. A bit of a mouthful, but there it is. The fund aims to support companies in tourism, creative industries and hospitality that are experiencing hardship because they're ineligible for other COVID-19 government grant support. The focus is to help companies manage cash flow commitments for the next 3 months, and eligible companies can apply for funding of up to £25,000. This is for small Scottish creative, tourism and hospitality businesses who have experienced at least a 50% loss of current or projected revenue, presumably on a self-declared basis as a result of COVID-19. The business must meet these criteria in order to apply. The company should have less than 49 employees, basically up to 49 employees. Less than 50 employees is another way of putting it. The company should have experienced at least a 50% loss of current or projected revenue, presumably on a self-declared basis, self-certified basis. You were not in financial difficulty before the 31st of December 2019, not in receipt of other COVID-19 government support, except the furlough scheme. That is an exception. You're not a pre-revenue company, and you should have a business bank account. In Wales, as well as the UK-wide COVID-19 assistance schemes, another scheme has been introduced, basically called the Economic Resilience Fund. The aim of this fund is to plug the gaps in the support schemes already announced by the UK government, including the Job Retention Scheme and the Self-Employed Income Support Scheme, which will guarantee, as most people know, 80% of people's wages and income. The £500 million Economic Resilience Fund is made up of two main elements. The first 100 millions of that fund is available through the Development Bank of Wales, and it will be available for companies experiencing cash flow problems as a result of the pandemic, and it will provide loans of between £5,000 and £250,000 at favourable interest rates. The second part of the Economic Resilience Fund, the £400 million part, the bigger part, under that part, businesses will be able to benefit from an emergency pot, which will provide grants of £10,000 for micro businesses employing up to 9 people. This includes sole traders employing staff. Grants of up to £100,000 for small and medium-sized firms with between 10 and 249 employees. And it will provide support for larger Welsh companies which are of critical social or economic importance to Wales. So we'll turn now to the Coronavirus Business Interruption Loan Scheme. The aim is very clearly to provide finance quickly to support the economy, jobs and business. There's been some negative press around this, particularly in relation to the speed of money being made available under this loan scheme and the difficulty in actually being able to get one of these loans. Hopefully this will be smoothed out and the process will become smoother and quicker as time goes on. Hopefully not too much time, because the important recognition in the design of this scheme in the first place is that cash is absolutely king for most businesses. So the fundamentals of the CBILS, it's run by the British Business Bank. That bank doesn't lend money but organises more traditional lenders, of which there are over 40, we understand, to make the money available. The money is available to businesses that are small under this definition. That is businesses with a maximum turnover of 45 million. Not that small then, but so that's the term, maximum turnover 45 million. The maximum loan that can be made is £5 million. The loan could be whatever is appropriate for the reason that the business needs the money. It could be a term loan, it could be an overdraft. Importantly, the loan is interest free for 12 months, and that's incredibly attractive to the borrower. And it's 80% guaranteed by the government, which is incredibly attractive to the lender. You can apply for a CBILS loan even if you qualify for a commercial loan. Usual evidence will be required though, remember that. You'll be asked for accounts, a business plan, a repayment period, proof that you can afford it. These loans are meant to be made available to viable businesses who are just being hit temporarily or having to go into a kind of temporary hibernation because of COVID. Remember also though that it's a loan and the borrower remains liable. But, it's an important but, the banks can't, or the lenders can't ask for a personal guarantee for loans up to £250,000 and only a 20% guarantee for loan amounts over £250,000, unsurprisingly, because the government is, after all, guaranteeing 80% of the loan. As a result of some criticism of the coronavirus business interruption loan scheme, the CBILS, a new loan scheme was introduced. The Bounce Back Loan Scheme. Effectively, it's a micro-loan scheme. It's available from Monday the 4th of May, and it's 100% guaranteed by the government. You may recall that some of the criticism of CBILS was around the guarantee, it only being 80%. The government felt that it will be unwise or not right to guarantee 100% of all loans, so they have restricted this guarantee to bounce back loans, but it is 100%, which will be a great source of reassurance to lenders, I'm sure. Now, the maximum loan under the bounce back loan scheme will be 25% turnover, subject to a maximum of £50,000. So in effect, the lower of 25% of your turnover, presumably turnover as recorded in your last set of accounts, and £50,000. So the lower of those two amounts. The minimum amount you can borrow under the bounce back loan scheme is £2,000, and the term will be up to 6 years. From the borrower's standpoint, the fact that the government will pay the interest under this loan, so in effect for the borrower it's interest free, and will pay any fees for 12 months, and a low standard rate is to be agreed to take effect after that first 12 months period, will be very attractive. Also, incredibly attractive, no repayments are required. I mean, you can make them, I guess, but no repayments are required for the first 12 months. So that's interest free, fee free, and repayment free for 12 months. Now, there's no outright test of business viability, but the business should not be one that is an undertaking in difficulty as at the 31st of December last year. The funds will be apparently made available shortly after approval of a loan, and the application process is designed to be simple on a standardised application form. It's also noted that CBILS loans can be converted to bounce back loans up to 4th of November 2020. So if you had a CBIL loan and it was within the conditions of a bounce back loan, you could, if you want to, and you probably would because the terms of the bounce back loan are a little more attractive, you could convert it to a bounce back loan up to the 4th of November this year. The government have announced a new death in service benefit for frontline workers. This will pay out a lump sum of £60,000 on the death of any frontline worker due to COVID contracted in the course of their frontline work. So this cover will be available to cover the death of National Health service, frontline staff, care and social workers, that's people delivering care, both adult care and child care, GPs, dentists, and even cleaners and porters in a care environment. The scheme is time limited, effectively for the time of the pandemic, and one can, I think, safely assume that there will be no adverse direct or indirect impact from this scheme on tax or benefits, any aspects of those. It's also important to note, I think, for financial planners that the introduction of this scheme should cause us to think a little more carefully around the extent to which individuals who are clients have sufficient life cover to provide the life, that the financial life that their families, that they would want their families to have should they die. Not through COVID, just should they die. It's this whole pandemic has caused us to think again, maybe in a little more detail and with a little more focus around general wellness, well-being and our own mortality. So I think it's a good time to talk about, in a sensitive way obviously, but to talk about the importance of providing sufficient protection for your family or for your business. So payment deferral now, deferment of VAT, deferment of self-assessment payments, and then the time to pay scheme. VAT first. For periods between the 20th of March this year and the 30th of June, there's absolutely no need to make a VAT payment. I mean, make it if you want to, but there's no need to. You can defer the making of that payment until the 31st of March 2021, and it's interest and penalty free. The return should be submitted, but there's no application required to defer, just don't pay. Information on how you will eventually have to pay the outstanding VAT, because you will remain liable for it, will be available in due course according to HMRC. You could look at this arrangement as a kind of interest-free loan. If you've got the money available and it should be paid to the government are now saying you don't have to pay us. They're effectively letting you retain the use of that money for quite a long period, right through to 31st of March 2021, as I mentioned, without interest and without penalty. So it gets you to be able to retain the use of that money without having to go possibly to the bank to secure a loan. So self-assessment payments due on the 31st of July 2020 can be deferred until the 31st of January 2021. As for VAT, interest and penalty free. As for VAT, no application required, just don't make the payment. It applies to all self-assessment payments as well, not just to the self-employed. There's also the time to pay scheme, which has been with us for a number of years now. It's the ability to enter into a effectively negotiation or discussion with HMRC, laying out why you're unable to make a payment of tax that isn't already covered by those two other deferment arrangements, those unilateral deferment arrangements I've just referred to, VAT and self-assessment. So it could be in relation to corporation tax. So you'll need to make your case, have a kind of business plan, and to put forward a reasonable repayment period and a schedule that HMRC think is reasonable, and that you then adhere to that. The phone number to call to have a discussion around this is 0800 024 1222. But be prepared, as it were, to have full justification for why you can't make the payment and how you propose to make the payment instead. So my focus throughout this programme and our learning objectives is to look in some detail at the job retention scheme and how it works, the self-employment income support scheme and how it works, business grants, the coronavirus business interruption loan scheme, and then VAT self-assessment deferment and the time to pay scheme. Hopefully you have achieved those learning objectives, and it remains for me to say the very best of luck and stay well.
Well, I hope you enjoyed that applied learning program, and more important, that you got something from it and got from it what you needed, what you felt or feel that you need to give your clients the support that they will, I think, inevitably be asking for, or maybe now asking for, because you have that information to give to them and make them aware that you have that information. I would say to you, though, that those schemes are being not endlessly, but regularly reviewed and updated. And so I would encourage you to go to TechLink under the whatever it takes section, and in particular to have a look at the matrix that we are keeping as up to date as we possibly can with every nuance, with every change that's being made to those schemes. So go to TechLink to keep up to date.